Business Television India.
Well, hello and welcome. Now it's time again to put the focus on United Spirits. The con call is starting. Let's cut across.
Partially benefiting from a one-time sale of our surplus Scotch stock in the UK. Excluding that, underlying net sales grew 6%. The Prestige and Above segment grew 9% on a solid base of 19% net sales growth in the same quarter of the previous year. The Popular segment grew 3%, adjusted for the operating model changes enabled by a softer March in Karnataka. In addition to the broad slowdown that the entire FMCG sector is grappling with, for us, this quarter was also impacted by dry days and restricted store opening hours resulting from the general election. Moving to the other lines of the P&L, COGS inflation as well as adverse price mix significantly impacted gross margins for the quarter, which came in at 47.3%. Despite that, I am pleased that we have delivered a like-for-like or indeed underlying EBITDA margin of 16% for the quarter, which is an improvement of 407 basis points versus the previous year. That is, after adjusting for the bulk sale and one-off restructuring costs in the base. So the 407 basis points is just pure underlying like-for-like margin improvement. Most of this margin expansion was made possible through savings in our operating costs, as well as the phasing benefit of marketing investments for the quarter. Adjusted for the one-off restructuring costs, staff costs for the quarter were lower by 19%, and other overheads were lower by 11% compared to the previous year. While we reiterate the fact that one quarter doesn't make a trend, these numbers give us confidence in our ability to mitigate gross margin pressures through operating efficiencies as we had guided in past calls. While the reported reinvestment rate for the quarter was 7.7% of net sales, after adjusting for the one-time sale of bulk Scotch, which obviously doesn't warrant any A&P, the reinvestment rate was 8.1%. Additionally, we trimmed down our marketing investment in light of the ongoing general elections, and our marketing investment will kind of normalize over the course of the coming year. During this quarter, we also launched McDowell's #1 Platinum campaign, which featured Vicky Kaushal during the ICC Cricket World Cup, both on television as well as on OTT, which is specifically Hotstar. We continue to stay focused on financing cost efficiencies, and interest costs for the quarter were down 11%. As a consequence of this, our profit after tax for the quarter was 197 crores, up 143%, mainly as a result of improved operating performance and to some extent lower interest costs. Looking ahead, while we continue to monitor the broader economic slowdown and its potential impact on the overall consumption in the near term, we'll have to wait and see if there is any specific impact on our category. Having said that, we remain committed to driving consistent and profitable growth of our business, and for us, really, top line and consistent margin improvement are important, and therefore I'd like to reiterate our medium-term ambition to grow the top line by double digit and improve our EBITDA margins to mid to high teens on a consistent basis.
Well, those were the sort of insights coming from the management in the contrast call again, and the stock basically has not done well for itself again post the results, almost 2% down. The margins were looking good, but the street again seems to be again not happy again overall here. But from there, now again, let's start the show. And in our Market Guru show, again, the guest for today is GIRISH Pai, Head of Research of Institutional Equities at Nirmal Bang. Mr. Pai, again, welcome to the show. And first of all, let me try and understand what's the outlook looking to you. It has been a sort of a correction, periodic correction. Again, these again they keep on happening. But in the context of current macro environment, whether we talk about slowdown, we talk about a broader sort of sentiment correction happening from foreign investors. What's the word of advice at present going out to clients on a broader market perspective?
So it depends on who you are. If you're a retail investor investing in SIPs, I would probably think that you should continue to do that over the next many years. So irrespective of way the market behaves, I think you should continue with your investments. And over the long term, I think the SIPs will probably deliver you fairly good returns. I think equities as an asset class will probably deliver you fairly good returns over the longer term. If you have not invested in mid cap and small cap mutual fund SIPs, I think probably this is a good time to start. While I'm not saying that this is going to be the bottom for mid cap and small cap stocks, I think the valuations have corrected quite substantially. While they can correct further, considering the slowing economy that we are seeing, and probably earnings cuts will continue even from here. I would think that this is probably a good time to get into some of these small cap, mid cap SIPs. If you're direct investors, I would probably think take a cautious view. I would probably think that direct investors with a fairly short term view, maybe 6 to 12 months, I think it's a cautious view that I have. I think economy is going to slow down further. My sense is probably we're going to see something like 6.5% kind of GDP growth. I think the index earnings, which are probably expected to grow by about 20%, at the beginning of the year, will probably come off. Maybe they'll probably grow at 15% or thereabouts, or maybe even lower than that going forward. Because I think every single sector we're going to see cuts in earnings. Even the corporate banks, in my opinion, which are probably going to deliver the biggest delta from an earnings perspective, I think they will probably see some cuts from at the margin, considering the slowdown that one is seeing, and the fact that some banks are pulling back in terms of credit to certain parts of the economy would mean that there could be some NPA issues coming up in the next couple of quarters. I think that could mean there could be some NPA related problems coming up for some of the even corporate banks where this is supposed to be a good year from a year-on-year earnings perspective. So that's the broad picture. But yes, from a longer term perspective, I think it's a good asset class to be in. But from a shorter term perspective, I think you could probably get better entry points.
Okay, so you will get better entry points that perhaps again could be sort of word here, and those entry points again will serve you well again for the next many years of growth here. That perhaps again could be a way again investors could be really looking for. But from there, Mr. Pai, as always, we always again do conversation with you. We try and find out the themes which are looking good to you at present. So let's talk about, before we talk about stocks here, what's the sort of broader themes, if you want to drill down into right now, which you think again can serve well on the earnings and are looking really good on a valuation parameter here. So before we go down to stocks, some themes.
So I think one needs to stick to the companies which are high quality, which are going to deliver you compounding in earnings over the longer time frame. They may look a little rich right now, but I think these are the stocks that one needs to buy in and hold on from a longer term perspective. Yes, I think the quarterly earnings picture has not been too great. I think there have been like one or two instances where I think the earnings have kind of surprised. But broadly, I think the earnings, for the quarter, at least it's fairly early to give a complete picture of what's going to happen in the June quarter FY20 earnings. But I think whatever we've seen thus far, across the board, we've seen weakness. Either the numbers have not been up to expectations, or the management commentary has been fairly poor, or probably a little cautious, I would say. So if you look at across banks, I think what we're seeing is even in some of the high quality banks like HDFC Bank or Kotak Bank, we're seeing a slight miss in numbers. The management commentary is slightly cautious. If you look at IT services, we're seeing a situation where I think except for Infosys to some extent, I think across the board we've seen disappointments from both revenue and margin perspective. I think some of the other sectors, the earnings season is yet to play out in full force. So I would kind of wait a bit to give comments on that. But broadly, my sense is that earnings are not looking too great, and I think that you'll probably see earnings revisions for FY20, fairly decent sized earnings revisions coming through.
And let me make your task slightly harder, and let me ask you this question. Amongst all the sectors you're talking about, again, sectors or subsectors, like if I'm asking banking, there could be private, PSU, NBFC. So similarly, in all the sectors, what's the current expectation? We know again now what the June holds, more or less again from an expectation perspective. For a FY20 perspective, which those sectors or subsectors you think again are looking as a safe areas for earnings growth?
See, as I said, I think across the board we do see some earnings cuts come through. But if you were to look at sub-segments within some of these larger sectors, so within financial services, we think that we'll probably see earnings resilience in, say, the insurance space to an extent. And insurance space is not really dogged by the asset quality problems that either NBFCs or either the corporate banks or even the retail banks are probably facing right now. So I would probably think that that is an interesting area to look at. But if you look at across the other parts of the market, I would probably think consumer staples will still deliver reasonable growth. I don't think the expectations are very high. I think the volume growth expectations are probably in the mid-single digit type for some of the larger consumer staple companies. I think they should be able to deliver that kind of a number despite what seems like fairly bad macro, be it from the rural side or from the urban side. So I think the valuations are rich there, but I would think that at least from the revenue and earnings growth perspective, they should be able to deliver. My sense is that the high quality retail banks should deliver. The only issue with them is the valuation and the fact that the management commentary has been a little cautious at the margin. So there could be some earnings cuts come through from that space. But as I said, I think across the board we probably going to see earnings revisions downwards. I think obviously the big ones have been auto. I think that is where I think the biggest cuts are probably going to come through.
Okay, so you got all the themes. I'm just naming again for the benefit of our viewers. Again, Mr. Pai talked about insurance. Again, you can again find the frontline names: SBI Life, HDFC Life. Again, a couple more. Again, we'll again ask this question also to Mr. Pai about insurance. But retail banks, HDFC Bank again, and the other ones, Axis, ICICI, perhaps again, a couple of them. And from there also again, as he talked about, auto is one area where he is concerned about earning downgrade. So that's opposite end of the theme we are talking about. That's more of a sort of fall here. But Mr. Pai, now let's drill down and go into insurance. You like insurance. What do you really want to buy at present in insurance? Which stock you're really bullish on?
So I think in the financial services space, we like insurance because we think that it's a far more solid space compared to the credit part of the market. We think that the credit part of the market is seeing a fair bit of competitive intensity. So if you look at the last 10 years, on the credit part of the market, you've seen at least two domestic universal banks added to the space. We've seen something like 12, 13 multinational banks being added. You have payment banks being added. You had small finance banks being added. You probably have about 2,000 odd NBFCs joining the race, so to speak. So credit market is a fairly competitive market, and besides the competitive intensity, what we also bother about is the asset quality issues that kind of keep cropping up in every cycle in some sense, impacting earnings. Whereas if you look at the insurance space, we think that that has been a fairly solid space. It's got very high entry barriers in the sense that you need to have access to bank assurance to actually drive growth and gain market share. So if you look at the last 10 years, there have hardly been any new entrants in the private sector insurance space, except for one. The private space is largely dominated by 4 or 5 large players right now. They've been gaining market share. So within that, we kind of recommending SBI Life Insurance. While we like the entire space, we think that SBI Life Insurance probably represents the best bet because if you look at various parameters, we think that kind of stands out on valuation metrics. So if you were to compare SBI Life with say a player like HDFC Life Insurance. HDFC Life Insurance is probably trading at somewhere close to 3.5, 3.8 times embedded price to embedded value. Whereas based on our numbers, SBI Life is coming at somewhere close to 2.2, 2.4 times price to embedded value. If you start looking at the metrics, we think that SBI Life looks fairly interesting, and we don't think that kind of big dichotomy from a valuation perspective should continue. So if you look at, say, persistency ratios, in terms of the quality of insurance customers that are brought on board, if you look at the persistency ratios here, we think that after Kotak, probably SBI Life has probably got the best persistency ratios in the industry. If you take a mix of 13-month, 37th month, and 61st month persistency ratios, that's what I'm talking about. If you look at the OPEX control, that cost control that SBI Life has got, it's probably one of the best in the market. You look at customer-related metrics like claims ratio. Look at complaints connect with claims, complaints connect with policies and stuff like that. It kind of indicates that SBI Life is a very different animal compared to SBI, the parent company. So SBI, the parent company's got a bit of a PSU image attached to it, and customer service levels are expected to be low. Whereas SBI Life has got a private sector kind of a flavor to the way it's kind of handling customers. So we think that SBI Life is a good play. We think it's a play which is driven by the very large bank assurance network that SBI Life has got. It's reaching somewhere close to 38,000 odd branches. It's being sold through about 38,000 branches, where this is the next largest player in the private insurance space is probably HDFC Life with something like 16,000 odd branches. So there is a fairly large branch network which is trying to sell these products. And more importantly, in the last 5-6 years, we've seen a very sharp increase in the market share of SBI Life. It's gone up by about 500-600 basis points as SBI Life has woken up to the bank assurance opportunity. So from a valuation standpoint, from a growth standpoint, from a customer operating metric standpoint, we think that SBI Life looks interesting vis-a-vis HDFC Life. And as I said, we are positive on all the insurance companies across the board. Sure. We're positive on the space. But within that, if you look at valuations and look at some of the operating metrics, SBI Life is what we kind of like.
Right. Mr. Pai, I want to ask you one question. What's the target price, average earnings growth you're looking for SBI Life over the next 2 years? Insurance is a long 10, 20-year story. But just for the next 2 years, what's the average earnings growth you're looking for SBI Life, and also the sort of target price you're looking for it?
So target price is a 12-month target price. That's about 900 is our target price right now. A little above 900 is our target price. We think that premia could grow in the late teens to early 20s for SBI Life in the next couple of years. We think that earnings growth could be somewhere there in our opinion. I think it could be like in the 20s in the next couple of years.
So the target price is 900 and that is a 12-month target price. That also again is telling you almost 12, 13, 14% growth again is still being expected by Mr. Pai again. So 12 months is again you're talking about, but insurance definitely for our viewers is a long-term story again. It's a portfolio building story here. But Mr. Pai, now let's go and slightly drill down into the SBI Life here. Just for a viewer perspective, in a very simple, very brief sense, what is the persistency ratio?
I'm sorry?
Persistency ratios, again, what you're talking about, again, there are 3 different kinds of persistency ratios, and when we are comparing SBI Life to HDFC Life, how basically one should really judge persistency ratios, and why SBI Life is being able to maintain high quality ratios?
Okay, so we've kind of built an index revolving around persistency. That's what my analyst did in terms of looking at 13-month, 36th, 37th month and 61st month. Persistency is continuing to hold on to that insurance product and continuing to pay the premium. So that is how we look at persistency. So if you hold on to that particular product and continue to pay premiums for 5 years, so that will be your 61st month persistency. So If I recall correctly, I think that number is closer to 50, a little around 50% for both companies. But if you do a kind of combination of 13th month and 37th month and 61st month, we get an index, and based on the index, what we find is that after Kotak Life, SBI Life has probably got the best persistency. So what it tells you is also, a bit to do with the selling that is done by SBI Life in some sense through the SBI branches. So we think that the persistency ratio being high is actually would mean that the mis-selling that's happening is low as far as customers are concerned, and the customers are kind of holding on to it, believing that there is value in the product in some sense. So broadly, that's our take on persistency.
Absolutely, again, as you are saying again, so in a very simple sense, viewers, again, you got the message here. Persistency ratios implies again stickiness of customer. Again, if I just want to say in a very simple sense here, higher the ratio, higher again you can say perhaps higher the sort of annuity premium visibility, and that also again higher perhaps the growth could be. So that is again one number which is important. But Mr. Pai, HDFC Life, you alluded, SBI Life is trading at a 25-30% discount to HDFC Life, and if I just want to do a quick comparison here, HDFC Life, is it also really attractive, or valuation something which again is not making the stock attractive right now?
So as I said, while we like all stocks from a long-term perspective, if you ask me to pick one stock right now, I would pick SBI Life. HDFC Life has got its set of issues. While it's a high-quality stock, high-quality parentage, I think the issues with HDFC Life revolve around the fact that HDFC Bank, which is the bank assurance, the key bank assurance partner, has also taken on Birla Sun Life Insurance and also Tata AIA life insurance to be sold. So while SBI sells SBI life insurance alone, it does not sell any other product. We have a situation now where HDFC Bank has started selling some competing products of Birla Sun Life Insurance as well as Tata AIA. So I would probably think that that means that the access to the network has been given to the competition in some sense. So based on IRDA norms, a bank can probably can tie up with as many as 3 players, which I think HDFC Bank has done. So there is a bit of a issue here. HDFC Life Insurance is a subsidiary of HDFC and not HDFC Bank, whereas SBI Life Insurance is a direct subsidiary of SBI. So to that extent, I would probably think that there is a lot of vested interest in SBI to actually push SBI Life Insurance product. That's on the how the sales is done and the potential competition there. If you look at the margins, so the margins of HDFC Life Insurances are better, probably the VNB margins or value
point taken,
as margins are.
As well, Mr. Pai, allow me to interrupt you primarily because we'll run out of time, and I want to ask you another stock here. So I got the message, I'm relaying it to our viewers, is that distribution network is definitely working in favor of SBI Life. Number of policies sold have been far higher than HDFC Life or SBI Life. While HDFC Life premium per policy has been higher, but number of policies again SBI Life is really giving a sort of positive fillip here. So Mr. Pai is at present again is really positive in SBI Life. But let me ask you the second stock which again you like at present, you think again valuations are looking compelling?
So the stock we've been pushing in the consumer durable space is Whirlpool. So this is a stock which a little there's a bit of an issue with liquidity, but we think that the kind of valuation it is currently trading at, it's going at about 33 times FY21. It's kind of come off from fairly high levels. We think that consumer durables as a space is a very interesting space, considering that there is a fair bit of underpenetration. So if you look at if you look at the refrigerator market, we have probably penetrated to the tune of about 23%. If you look at the washing machine market, that's penetrated to the tune of just about 12 to 13%. So one is the underpenetration part, the fact that our GDP continues to grow at say 6-7%, and you add some nominal, you add some inflation to it, maybe like 4%. So there's a fair bit of nominal growth in GDP. which would mean that there is a percentage of population which is kind of which aspires to get these products and whose incomes are improving as years pass by. So if you look at the affordability of these products, I would probably think that these products are becoming more affordable as years pass by. Whirlpool is a player, a high quality player in the refrigerator side. So if you look at the revenue mix of the company, about 55% comes from refrigerators, about 20% comes from washing machines, and these two segments are a fairly consolidated segment of the consumer durables market. Top 4 or 5 players constitute almost like 90% of the market. Whereas if you look at the AC market, the air conditioner market, it's a far more divided market, far more market which has got about 20-25 odd credible players out there. So we would think that it's in a space which is good, growing. We think that both products should deliver you low teen kind of volume growth, and along with premiumization, we think that revenue growth should be in the mid-teens. We think that there is a little bit of scope for margin expansion, which could probably deliver you 15, 16, 17% kind of EBITDA growth, and other income growing, which should mean that high teens to early 20s kind of earnings growth come through. So it's a consumer durables is a space we like a lot, and within that, Whirlpool is a good company, a very good company.
What would be the target price average earnings growth you will look for Whirlpool over the next 12 months?
So target price we have on Whirlpool is about 1840 thereabouts, and earnings growth we're looking at somewhere close to 20% on a CAGR basis between FY19 and FY21. So as I said, the company delivers you phenomenal return ratios, pre-tax ROICs in the 150% region, which I don't think very many Indian companies deliver that kind of return ratios, and it's a negative working capital company for the last 5 years in succession. So it's a high quality play in one sense.
High quality play, ROIC again, you don't hear that number at all again, I can definitely say again. So that's very high ROIC plus 20% upside is what again Mr. Pai is looking for the stock here. I have 2 more questions, and we now have limited amount of time as we move towards the end of the show. So let me do a rapid fire here. One as an update for our viewers on Inox. The last time again we have been talking, stocks have done really well again from the time we started talking from September, October onwards. As an update, June quarter was a phenomenal quarter. What is sort of recent view you have on Inox?
So I don't think the June quarter has been phenomenal quarter. The March quarter was a phenomenal quarter. A June quarter has been probably a tepid quarter because of the World Cup, and probably because the content hasn't been up to the mark. So except for Avengers and maybe like Kabir Singh and I think Bharat, I don't think very many other movies really delivered. And also my sense is that footfalls were a little tepid because of World Cup. And I think the ad rupees, the ad spending was also a little lower because I think the ad spending was shifted more towards the other medium. So my sense is that in the June quarter, the numbers are going to be slightly tepid, which is kind of reflected in the stock price. So I think Inox has come off from about, if I recall, the stock price went up to as high as 380 or thereabouts. It's now closer to 300. So I think it's a good time to actually accumulate the stock with a long-term perspective. The story remains the same. It's a film exhibition industry, or at least the multiplex industry is a oligopoly in its infancy. We have about 3,000 multiplex screens in the country. China currently has about 60,000 odd screens. While I'm not saying that it's going to go to 60,000 anytime near in the near future, I think we'll probably see high single-digit growth in the screen number, along with 4-5% increase in inflation. You'll probably get over the long term, low to mid-teen kind of revenue growth and slightly better earnings growth. So it's a very interesting story from a long-term perspective.
Absolutely, point taken. The sort of message here is that the premise remains same, thesis remains same, long-term story remains same here. Time again for accumulation. A quick recap again. A sector which we have been covering again regularly again with Mr. Pai over the last many months here. Mr. Pai, now the sort of last question I want to ask you again, something which you track so closely is the IT sector. We have seen again that the earnings season again a couple of them still again yet to come by. My question is slightly directed towards the mid-cap IT stocks. Very heavy selling has been seen. According to you, what has been the reason between this sort of performance? Infosys singularly favorite, mid-cap IT stocks very heavy selling. How again basically you can explain that?
So I've been negative on the IT services sector for a while now, and within that I've been telling investors to avoid mid-cap IT because I believe that the best, at least from a medium-term perspective, the best in terms of revenue growth and earnings growth is probably behind us in FY19. I think the situation is going to get a little tougher in FY20 and probably going to get worse in FY21. So what we've seen in the first quarter, and I was not expecting this kind of a situation from some of these mid-cap IT firms, is a situation where the revenue delivery and margin delivery has been below market's own expectations, which are kind of a little muted. So I would probably think that one should avoid mid-cap IT in total. If you have stocks there, I think probably you should sell them off. And if you want to continue to hold on to IT, my picks in the sector would be TCS, Infosys, and HCL Tech in that particular order. I would think if you're trying to build a portfolio of stocks, I would probably be underweight IT services by say 300-400 basis points vis-a-vis the benchmark, and hold those 2-3 stocks that I mentioned, and I avoid mid-cap completely. Because I think that right now they're kind of holding up because there are problems with the domestic economy, problems with asset quality in some of the banks and stuff like that, which is probably leading to some amount of money shifting away to IT services stocks. But I think from a back-ended earnings growth perspective, I would probably think that FY21 could probably throw some nasty surprises from a revenue perspective. So I'm expecting industry growth to be 0% in FY21 for the industry, whereas I think most of my peers are anticipating high single-digit to maybe low double-digit kind of growth.
Well, Mr. Pai, thanks a lot for giving us your take across the picks. Let me recap. Whirlpool and SBI Life are the two top stock picks, which again we have talked about in this show. We took views on HDFC Life. We took a recap view again on the movie exhibition sector also again. That is also looking like a good accumulation zone here. And again, we gave you views on the IT sector also. Mr. Pai, so it was a pleasure talking to you, and we look forward to our next interaction. And with that, it's a wrap on this edition of Market Guru. Thank you so much for watching us. Hope you enjoyed it. We'll take a short break, and after a break, more conversations, more action lined up on the other side.
Public issue of secured NCDs with interest rates up to 9.7% per annum. Shriram Transport Finance. Vishwas Jeet Ka.
Why ETFs are important?
ETFs are extremely flexible because it assures that you are linked to the market.
Right journey was not from FD to balance fund, rather it was from FD to money market fund or FMP.
Overall discipline in terms of asset allocation is very important. So don't go extremely overboard in any particular class of asset.
You should know your fund, you should know your fund manager. Both are going to be very important.
Tune into the MF Guide, weekdays at 12:30 p.m. only on Business Television India. Political developments, market fluctuations, the stories that matter and their impact.